Gold just hit an all-time high, but then it crashed, and everyone seemed to panic and sell it off. They thought the party was over. But here's what nobody in financial media is saying. The gold crash was actually the opportunity. And right now, while everyone is still nursing their losses and watching the headlines, the smartest investors in the world are doing something completely different. They're not buying gold, they're actually buying gold stocks. And the data shows why that's about to matter more than you think. Hi, I'm Jacob Wade. I'm a financial coach for high-income earners. And if you like market prediction videos like this, hit the like button below so I know to make more deep dive videos just like this one. Now, I do have to tell you this video is for educational purposes only and is not financial, tax, or investment advice or an offer to buy or sell any security. It is not personalized to your situation. Consult a licensed financial professional before investing. Now, let me set the stage here for gold. Gold had an absolutely historic 2025. We're talking over 60% gains. More than 50 all-time highs happened in a single year. And the metal climbed from below $2,700 an ounce at the start of the year to above $4,500 an ounce at the end of the year. That's not a rally, that's a reckoning. And then 2026 came around in January, was even crazier. Gold actually surged past $5,000 an ounce, and it hit an all-time high. Investors were convinced this thing was going to go to $6,000 an ounce, maybe higher, but then geopolitical tensions spiked. The Fed tore up its rate cut playbook, talk shifted from rate cuts actually to a potential rate hike, and gold actually did what it does when uncertainty spikes too high. It sold off hard. Corrections of 10%, sometimes more in a single day. The kind of moves that make people panic and sell. And honestly, that's where most investors stopped thinking. They actually just saw gold going down, they panicked, they sold, and they assumed the bull market was over. But if that's what you thought, here's what you might have missed. While gold prices were crashing, something fascinating was actually happening with gold stocks. They didn't sell off the same way. In fact, even after this year's incredible surge, gold mining stocks remained at historically low valuations. We're talking price to earnings multiples that looked absurd compared to where they've been historically and certainly compared to the broader market in general. So that gap between where gold went and where gold stocks still are, that's not a mistake. That's an opportunity. And it's exactly what the next few predictions are going to explain. All right, here's prediction number one. That crash we just saw, the sell-off in January and in March, that wasn't the bull market breaking. It was the bull market working exactly as it should. Most investors see a 15% correction and they panic and sell, but the data tells a completely different story. Now, here's the pattern. Every major gold bull market, you don't get a straight line up. Historically, gold actually experiences 5 or even more 10% plus corrections within a single bull cycle. That's actually normal. It's what washes out the momentum chasers and leaves behind the structural buyers, the people who actually understand what gold is and believe in it. Now, if you want to look at a stock, let's take Oceana Gold, ticker symbol OGC. Now, during the January rally, it surged with everything else, but when the correction hit, OGC actually pulled back a little bit less. And here's the thing. The fundamentals of this stock didn't change at all. The mines still produce, and the company is still making money. And Zen Ratings, that's our proprietary quant ratings system that distills 115 fundamental due diligence checks into an easy-to-understand letter grade, A through F, just like school. Now, OGC is an A-rated stock with exceptional value and momentum grades specifically. Now, when the sell-off happened, the market was selling indiscriminately. That's panic, and panic actually creates opportunity. So if you sold because of the correction, it's possible you sold when weak hands were leaving. It was right before the smart money actually repositioned. So as an investor, you have to understand that real bull markets have corrections. This is one of the scars of a real bull market. Now, the next leg up for gold stocks is coming for people who actually held. But why is gold correcting at all? What's really driving this? So that's prediction number 2, and it's going to show you exactly where the smart money may be actually rotating. So prediction number 2 is that gold stocks will dramatically outperform the metal itself. Now, last year, gold was up 65%, and that's incredible. But gold stocks, the actual mining companies themselves, many of them were up 100, 150, or even 200% on the year. That's not a coincidence. It's leverage. So here's how it works. When gold goes up 10%, a gold mining company doesn't just make 10% more. It makes a whole lot more because they've already paid for the mine. They've already paid the fixed costs. So when the metal price rises, every additional ounce that comes out of the ground flows directly to their bottom line. That's called operating leverage, and it's powerful. So in 2025, that leverage worked because central banks were buying gold and passive investors were buying gold ETFs. But in 2026, something's actually shifting, and this is important. Active investors are waking up to the fact that if you really believe in gold, you should own the stocks, not the metal. So for example, let's take a look at Orla Mining, ticker symbol ORLA. It's an A-rated stock with strong growth and momentum scores. It was also a recent stock of the week pick from WallStreetZen. And by the way, if you want to see more stock of the week picks, be sure to subscribe to WallStreetZen's free newsletter. And I'll put the QR code on screen here so you can scan it, or you can just go to the link in the description below. And if you sign up, you'll start receiving the newsletter every single Monday. But I digress. So ORLA didn't just move with gold prices, it's positioned to capture that operating leverage that I just described. So every dollar increase in gold price flows through to the earnings. So that's why stocks like ORLA can outrun the metal itself by 2 to 1, sometimes even 3 to 1. The smart money actually knows this. So they're not buying gold bars, they're buying gold mining stocks. And right now, honestly, most retail investors are still holding the metal itself, but that gap is closing and it's going to close fast. And if you're getting any value out of this video and don't want to miss any future timely market predictions, hit the subscribe button below. And if you hit that little notification bell there, you'll actually be notified every time we drop a new video. So honestly, why is gold structurally supported regardless of what happens next? That's actually going to be prediction number 3. So here's prediction number 3. And this may be the one that matters the most for understanding gold's next decade. Now, financial media is obsessed with interest rates and inflation prints, but there's something much bigger happening underneath all of this. The world is slowly, deliberately moving away from the US dollar. This isn't a conspiracy theory, just look at the actual facts. China is buying gold at record rates. Russia is loading up on gold reserves. The BRICS nations are explicitly discussing de-dollarization, and individual investors across Asia and Europe are moving money out of dollars and into gold. The geopolitical tensions we mentioned earlier, Venezuela, Iran, trade wars, they're accelerating this process because they're making people lose faith in the dollar's stability. And when you lose faith in a currency, especially one as big as the US dollar, you buy gold. It's the oldest insurance policy in the world. And de-dollarization isn't a cycle, it's structural. It's going to take years, maybe a decade, but it's happening whether the Fed likes it or not. And here's why this matters for gold stocks. A company like IAMGOLD, ticker symbol IAG, operates mines on multiple continents. When the dollar weakens because of de-dollarization, 2 things happen simultaneously. First, gold prices go up in dollar terms. Second, their cost in foreign currencies actually decrease. They're getting a double tailwind. And the Zen ratings show this. Again, IAG is an A-rated stock with outstanding value and financials scores. So this is playing out in real time. And this is exactly the kind of structural positioning that wins over the next 5 to 10 years. So we have the correction creating opportunity right in front of us. We have stocks outperforming metal, and we have this massive structural trend, de-dollarization, that's now completely out of the Fed's control. So here's prediction number 4, and it explains why the Fed's next move doesn't actually matter for gold at all. Let me walk you through the trap that they're in. So right now, inflation is stickier than the Fed wants it to be, so they have 2 choices. Option 1, they keep rates elevated or even hike to fight that inflation. But if they do that, the real yield on bonds gets worse and gold becomes the obvious alternative. You buy gold instead of bonds. But option 2 is cut rates because the economy is slowing down and they need to stimulate the economy. But if they do that, inflation concerns come roaring back and people buy gold as a hedge against currency debasement. Either way, gold wins, right? Heads, gold wins, tails, gold wins. And this is the macro structure that's locked in right now. The Fed can't create an environment where gold doesn't win. They're trapped. And when the Fed is trapped, gold mining stocks like Kinross Gold, ticker symbol KGC, for example, benefit from both the macro tailwind and the margin expansion we talked about. Now, KGC is a B-rated stock with exceptional financials, among the strongest in the entire sector. So whether rates go down or up, KGC mines are still producing. The gold is still coming out of the ground and the company is still making money either way. This is what structural positioning looks like. This is where the smart money isn't timing the Fed at all. They're just positioning for the fact that no matter what the Fed does, gold is the answer. Now, let's look at where that actually shows up in the numbers. So here's prediction number 5, and this is where the fundamental math gets really interesting. Gold is up 65% from a year ago, but here's what most investors don't understand. The cost to mine gold hasn't gone up 65%. In fact, it's barely budged. So when you own a gold mine, you have fixed costs. Labor, equipment, permits, those are relatively locked in. So when the price of gold skyrockets but your costs stay flat, something magical happens to your profit margins. They expand dramatically. That's pure operating leverage. And right now, it's at levels we haven't seen in years. So take a company like Newmont, for example, ticker symbol NEM. It's the world's largest gold producer. Now, when gold was at $2,500 an ounce, they were barely profitable. Now that gold is over $4,000 and climbing, they are printing money, and that money flows directly to shareholders. And again, Zen Ratings shows us why. NEM has an A rating. But perhaps even more noteworthy is its exceptional financials rating of a 99.7 out of 100, among the very highest of all stocks that we track and the strongest in the entire gold sector. Now, this is not speculation. This is just the math that I'm showing you. And this is what happens when you combine structural gold demand with operating leverage. The earnings growth could be shocking. So with all that, that's the setup. The correction was actually healthy, and stocks are going to outperform the metal itself. That structural trend, it supports it all, and the margins are expanding. Everything is pointing in the same direction, and that's exactly why the smart money is positioning now. So there you have it. Do you agree with my gold predictions, or do you have any different ones to add? I'm curious to hear what you have to say, so drop it in the comments below. Now, if you like these predictions, be sure to check out our companion video featuring 4 important oil market prediction, and you can watch the entire video right here.